And what are some traps that will trigger the AMT for some individuals?
So AMT triggers have really shifted a lot over the years. In the early days, it was really built around a lot of aggressive tax shelters of the day, particularly around real estate strategies that were popular decades ago. In today's environment, it's a little bit different. The biggest triggers we tend to see for AMT are a lot of the deductions that come on Schedule A of the tax return, those itemized deductions. That includes the deductions for state and local income taxes paid, as well as property taxes and even sales taxes that are deducted. Personal exemptions are often a trigger for the alternative minimum tax, particularly for large families. And anything that goes in that big bucket of miscellaneous itemized deductions. So ironically for many of us, our advisory fees themselves that go into that category become AMT triggers. And if you add up too many of them and it crosses a threshold, you end up being subject to the AMT.
So what's the best strategy if you're an advisor? Obviously, you want to take things like tax consequences into consideration. How do you incorporate AMT considerations when putting together a plan?
We look at AMT planning a couple of different ways, because the reality is different clients are subject to the AMT to varying degrees. And I kind of overgeneralizing a little, I tend to break clients into three categories. There are those that are in regular tax land. They're subject to the regular tax system until something big and dramatic happens with their AMT rules, they're not likely to face the AMT. There are some clients at the opposite end of the extreme. They are squarely in AMT land. Anything that's an adjustment for AMT purposes, they just don't get. Just pretend that deduction doesn't exist for you, because it doesn't for a long time to come. Then we have people that are right on the border between the two lands. And for those folks, we look at a slightly different set of strategies. It's not, hey, you can ignore AMT, or hey, just forget all those AMT deductions, you'll never get them. The people on the borderlands, we find, is a lot of very intensive year-to-year tax planning. We might look and say, okay, this year you're not subject to the AMT, but next year you probably will be. So we're going to take your fourth quarter estimated tax payment, and we're going to make sure you pay it before the end of the year, not by January 15th of next year, because we want the deduction this year when you're not subject to the AMT, and avoid it next year when you will be subject to the AMT. And so depending on which of those lands clients are in, regular tax land, AMT land, or in the borderlands in between, really drives which strategies we're focusing on.